A bold statement. Bangladesh's banking sector is facing a critical challenge, with state-owned banks' capital recovery plans raising serious concerns. The story unveiled. The Bangladesh Bank has taken a firm stance, rejecting the capital recovery plans of 4 state-owned commercial banks. These banks, Agrani, Janata, Bank and Rupali, are collectively grappling with a staggering TK 31,000 crore capital shortfall by 2024. The central bank had set a 5-year timeline to rectify this deficit by 2029, but the proposed plans have been deemed unrealistic. Unraveling the numbers. Agrani Bank, despite a net loss of TK 937 crore in 2024, aims to reduce its capital deficit by TK 6,245 crore within 5 years. This seems ambitious, given its sporadic net profits over the last few years. Bankers highlight that addressing a capital shortfall requires increasing net profit, government recapitalization, or reducing non-performing loans, NPLs, none of which are currently favorable for Agrani. The central bank has asked Agrani to revise its plan, aligning it with financial realities. Agrani's data reveals a TK 7,692 crore capital shortfall against a minimum capital requirement, MCR, of TK 9,444 crore in 2024. Their proposed recovery path appears steep, with targets of reducing the deficit by TK 3,140 crore in 2025, TK 523 crore in 2026, and so on. Basic Bank, with a TK 8,621 crore capital deficit, projects reducing the shortfall to TK 3,257 crore by 2029. This ambitious plan comes amidst consecutive net losses. Basic's managing director, MD Kamruzzaman Khan, assures a realistic roadmap to restore profitability and depositor confidence. Janata Bank's plan predicts an increase in its capital shortfall from TK 10,700 crore to TK 20,600 crore by 2029. However, their recent net losses cast doubt on these projections. Rupali Bank, with a more modest plan, aims to reduce its TK 3,970 crore capital shortfall to TK 2,991 crore by 2029. Sonali Bank and BDBL, on the other hand, report capital surpluses and have submitted achievable improvement targets. The sector-wide crisis. The banking sector's capital shortfall has soared to over TK 1.55 lakh crore as of June 2023, with 24 banks failing to meet minimum capital requirements. Economists emphasize that profit growth alone won't address structural weaknesses. They advocate for comprehensive balance sheet reforms, stronger risk management, and aggressive NPL recovery strategies. Controversial take. Some experts argue that the state bank's plans, while ambitious, might be a necessary step to attract government support and potential mergers. Others believe these banks should focus on core banking operations and leave specialized recovery strategies to experts. What's your take on this? Should these banks be given more leeway, or is a stricter approach necessary to ensure financial stability? Share your thoughts in the comments.